And Rich, you're in Ohio.
As always, yeah. It's
When was the last time you left the great state of Ohio?
Buckeye
well,
State.
probably the Acima conference in October. So I traveled so much for like 20, 25 years. I have just been like, decompressing and vegetating in my office for the last year and a half. It's been great. I am going to get out on the road more this year for sure, though. So,
I mean,
Hopefully you can get out of your office and like go to the store or walk in
wow,
the
with
park.
grocery delivery, why would you do that? Yeah.
Right. And how's the dog today?
I've got just to be safe, his remote and then, Milkbone in case he starts going crazy. So, but he's in this office, the Frenchie with me 24/7 now because we have to
Yeah.
separate him and the German Shepherd want to kill each other. So, I had to,
Mark,
yeah,
Mark, you should feel honored because sometimes Rich sends a shock collar to our guest,
ha!
and he waves that. It says, if you say something out of line, so the fact that you don't have that, that you're not subject to that, hats off.
Perhaps he just assumed that it would have to go off so much it would just burn out at some point. So, yeah.
Right.
All right, let's go ahead and get into it. My name is Rich Swerbinski with Onward and Upward Consulting, and this is the big picture. Thank you for joining us as always on a Thursday afternoon. Pleased to be joined as always, my esteemed colleague and co-host, Rob Chrisman. Rob is in a bad hotel and the virtual background. But Rob, how's Vegas treating you?
Ah,
Are you a gambler? You seem risk averse, the water stocks. You're probably not a big gambler.
I'm not. In fact, I gave a show, a tell in my opening line today in my paragraph in my commentary, saying that anybody with a capital markets background knows the only way to double your money in Las Vegas is fold it in half and put it
Money,
back in your pocket.
yeah.
So yeah, I'm not. I enjoy watching it a little bit, and I enjoy the people watching. I get up at 4 a.m. Sometimes wake up a little bit earlier. I might go down to the casino before I work on the commentary just to see who is at the table at 3:30 in the morning. It's something.
I can imagine. Yeah.
Yeah.
And this week, pleased to be joined once again by Senior Advisor for the Cato Institute, former FHFA Director. It is our friend Mark Calabria. Mark, thank you so much for joining us again and for being on the show today.
It's such a pleasure to be back.
So much to get into. Excited for the conversation. And the show, as always, presented by our great friends and partners at Depth. 2 decades of ably serving the real estate finance industry, fintech industry, trusted PR and marketing firm, strategic communication, branding. If you need your story told, Depth, they're the ones to do it for you. And their fearless leader, Carrie Milam, was on the Chrisman podcast this morning, if I saw correctly, Rob, in your commentary.
She was. It was a very good interview. And I saw Carrie and Leslie at the IMB in Austin for a few days, seeing them in action. Very professional, very professional.
Well, great segue, because I want to get your thoughts on the IMB conference. The Fed, as expected, held serve yesterday, no action. GDP report this morning, kind of as expected. Some of the underlying numbers a little better, maybe the headline number a little less, but all in all, really kind of as expected. Inflation kind of hanging around like that cousin that shows up for the weekend and then stays for 6 weeks, like cousin Eddie. Inflation, it's just lingering around. But so we'll skip right through that, Rob. I want to get your thoughts on the IMB conference this week. What's your takeaways?
Well, let's go back to that inflation comment, Rich, because inflation near and dear to all of our hearts. I mean, we've been the focus of the capital market seems to shift over the years. For decades, it might be money supply, then it goes to unemployment, and now we've been on this inflation thing. A little bit of inflation is fine. I think a little bit goes a long way, and I think you really can't. If you're the Federal Reserve, you can't just like I will tell you, if you're Donald Trump, you can't wave a magic wand and tell rates to go down and they go down. I don't think the Fed has total control over the inflation rate. You know, you can have a drought in Kansas, or a ship gets stuck in the Suez Canal, or somebody attacks somebody, or or the cocoa bean harvest is meager, you know, whatever it might be. But inflation certainly has come down. I think that's given the market some comfort. But you know, 2, 3, 4%, I think is okay. Um, and certainly that was a discussion topic. Mike Tony presented it at the IMB in Austin. And I think the MBA has ratcheted down their expectations for volume for 2025, and rightly so, you know, with mortgage rates somewhere, you know, 6 and 7/8, 7 and a quarter, somewhere in there, and expected to be there for a bit. Of course, the bond market itself, you know, will go up and down a little bit here, a little bit there. But Mike presented a picture that was echoed by the GDP numbers this morning, that basically the economy is doing okay, despite what we heard during the campaign, and interest rates are where they are for a reason. And you know, let's get on with other things. So the other things talked about at the IMB were things that independent mortgage banks, uh, you know, differentiate themselves using versus banks or credit unions, or even brokers for that matter. So, you know, the focus was on that, you know, channels like customer, you know, how to retain customers and so forth if you're an IMB, and, you know, servicing, the value of servicing, how servicing has helped so many IMBs over the last year or two. The diverse segments still important. You know, what are you doing to address different populations in your lending area? How not to run afoul of the CFPB, and lastly, you know, what might happen with Fannie Mae and Freddie Mac. uh, Mark, I know that we're going to spend the majority of the time here talking about that, and that's obviously your specialty. But the general thinking is that, all right, with the Trump victory, we are heading back down the path of somebody pushing towards removing them from conservatorship. What does that mean? Um, and what it might do to rates, and what people should be aware of. So yeah, it was a good topic. You know, Rich, I'll say this about the IMB. You know, you kind of go through after the national conference in October. Many typical conference goers don't have much going on in November, nothing going on in December, first chunk of January, nothing going on. So there was some pent up conference demand. It was nice to see folks, see who was there, see who wasn't there, and just touch base and be social. And the sessions were good. So you know, it was a very nice event. It was nice. It was at the JW Marriott in Austin, so they knocked it out of the park. Food was good. And the it was relatively self-contained, and it was a good event. So I would say the overall mood was, I like to use this word, pragmatic, you know, realistic. Nobody was thinking, oh, we're gonna, you know, do another, you know, 3, 4, 5 trillion this year. It's basically rates are where they are, and how are we going to continue to help clients.
Good stuff. And Mark, since your last appearance on the show, been some developments. We've had Treasury Secretary nominee Scott Bessent, HUD Secretary nominee Scott Turner, FHFA nominee Bill Pulte. A little earlier, you were nominated. It was much later in the game, if I remember correctly.
Well, so keep in mind that, you know, we still had Mel Watt's term for 2 years. So when I was nominated, you know, the director was not removable by the president. So that has changed. And, you know, the FHFA director at this point is going to turn over with every election. And so that's certainly a different agency and environment than I inherited.
Yeah. And Bill Pulte, do you know Bill Pulte
A
at all?
little bit, not well. Talked to him a few times. Certainly, getting to know him. You know, I'm impressed so far. But you know, again, we'll see. You know, I think he's got to have a hearing within the next 2 to 3 weeks. You know, we'll get to see, you know, how he performs in public and how he answers some of these questions, how he deals with members of the Senate. But you know, I think like a lot of people, still getting to know him.
Yeah. He's kind of regarded as a, you know, like problem solver with experience in the home building space, obviously. I mean, just your general sense, do you think he'll prioritize the release of Fannie Freddie as a first priority over maybe, home builder initiatives or housing affordability initiatives?
So let me, preface for covering the entire conversation. Everything I'm going to say today is my own opinion, so I don't speak for anybody else. And then I want to next say, you can walk and chew gum as FHFA director. So, you can have multiple things going on. I mean, we were, continuing along an exit while we were handling the pandemic. So I don't really think you should look at it as an either or. My read of him, and I don't want to veer too much into pop psychology, but I think Bill wants to make a big splash. I think he wants to leave his mark on the agency and on Fannie and Freddie. And I think the most powerful way you could do that is to get them out. You certainly could, tweak some of the credit box and this or there, but to make a lasting legacy, which is what I think he's going for, is to get these companies out, and to get them back on their feet and fix them. Now, certainly, we all understand that the probably part of the mortgage market that is most constrained, is the ADC lending channel for construction lenders. That's, I mean, mortgage lending writ all, it's, in my opinion, not that hard to get a borrower qualified. But you try to get a small builder qualified for ADC lending, and that's a completely different animal. Certainly, there have been a lot of debates over the years of how much legal authority Fannie and Freddie could do. We spent time on that when I was director. I think there are some serious legal constraints on how active Fannie and Freddie could be helping home builders. But that said, I certainly expect Bill to spend some time in that area.
Hmm.
So,
And
so the uh, what he hasn't been confirmed yet, right?
Correct. That's
Uh,
absolutely. He's been nominated. There hasn't been a hearing announced. Um, as a former Senate staffer, I think as you guys know, I was on the banking committee staff for a long time, and my view is always, especially as a nominee, don't take anything for granted. Don't assume the Senate's going to nominate you. Always be modest, and don't start doing the job until you're in the job. Yeah. No,
hold on, hold on.
there's no way to annoy the Senate more than if you just start automatically thinking that they're just going to rubber stamp you. They have advise and consent, support, and roll. Senators across the aisle take it quite seriously, and you have to be respectful of that. So, that's why you say they're the nominee, they're the designee, and of course, hopefully in his hearing, he'll remember to say things like, if confirmed, I'll do this. And so it's hard to handicap at this point. There's lots of things that can go sideways. Obviously, the numbers are quite close in the Senate. So I think my money would be he's gonna get confirmed. But there's always the unknown. What don't we know about him that hasn't come out?
Well, it's interesting. I need to interject here somewhat. President, some would argue the President Trump was doing the job before he actually took office. I would say, and I realize this is your
Sure.
opinion only. My opinion is that we've seen some 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 nominees who have really turned some heads in terms of past activities and thoughts and actions. Uh, Bill Pulte seems relatively vanilla,
I,
relatively
w- I,
benign.
I, I I would agree. He's no Matt Gaetz. So, that's as far as we know, he's not. So,
Right.
and of course, some of those nominees dropped out and got pulled out. And you certainly have a debate going on around some of the national security nominees. And of course, you've got HHS, it is interesting to see the Democrats suddenly decide they don't like Kennedys anymore, but that's a controversial nomination that, while I would probably bet he gets confirmed, you'd have to give me really good odds. It's going to be close. I think the numbers will be extremely close. And this applies to Pulte as well. All of these nominations are going to require floor time in the Senate. So even if it's you get out of committee, I mean, Pam Bondi for Attorney General just got out of committee on a party line vote, and she's going to require floor time. My gut is that even if Bill manages to get some Democrat votes in the banking committee, that the really wrinkle and randomness over his process is going to be when are they able to schedule floor time on the Senate, and that's hard to do. And in fact, let me try to remember. I think I was at a committee almost 2 months before I got to the floor, or something like that. So it's not automatic. And let's also remind ourselves that while FHFA, Fannie, Freddie mortgage finance is incredibly important to the three of us, there are hundreds of nominations that are going to be before the Senate. And as painful as it is for the three of us to recognize, people aren't always going to look at mortgage finance as the top 10 issue that needs to be moved. So
Yeah.
let's just keep that in mind. Cabinet secretary is the first priority, and Pulte will be competing for floor time with a lot of other nominees and a lot of other constituencies that will feel it's important to move those nominations. So all that said, I think he's got a good chance of being in place by May. But, again, there's a lot of moving parts.
Yeah. I would say the general feeling, consensus, whatever you want to call it, at the IMB this week was that it's good to have somebody there who understands something about what we deal with. It's not putting um,
Another
it,
Calabria in place, that with the fear. You can get in there, Rob. It's okay.
well,
I've
no,
got thick
just
skin.
yeah, he knows, at least his family knows the business. He's been exposed to it. He knows some of the concerns. Um, so good. I hope that he does prove uh, beneficial to lenders and to builders and to real estate folks in general. So that would be nice to see.
I think it's also important, he's got a relationship with the Trump family. And so the importance of this is primarily you're going to have good staffing. There are good people at FHFA who'll bring in a good team. You can bring the experts in. At the end of the day, whether you get Fannie and Freddie out of conservatorship, it's fundamentally a matter of will, stubbornness almost. And can you navigate the politics of it? And I think the fact that Bill has connections to the family and to the White House, to me, raise the odds that he can kind of push this through. And again, I mean, I came over from the White House. I had connections, and people knew that I was going to be able to navigate the politics. And I think that fundamentally is the most important issue of it. I mean, a lot of the details. I mean, he's going to have to learn Washington. That's fine. We all learn it at some point. There are aspects of the industry he's going to have to learn. But to me, the most important feature is, does he have the connections and the stamina that you can push this through? And I think he largely does. And that probably matters more than the other issues.
So, Mark, I'm not going to answer this question for you, but I will partially.
No.
So one of the topics that's out there is how much, to be blunt, frank, cut to the chase, how much will Fannie Mae and Freddie Mac's rates go up, if at all, once they are released from conservatorship? And I know this is an intricate question. I wanted you
Sure.
to, for the viewers slash listeners, how do you answer that question?
So I think you need to start taking the pieces apart, and then you put them back together. So let's start with, what is the theory behind why rates would go up? So, and let's start with the legal, and then we could get to market speculations. So I wrote to remind everybody, as a legal matter, there is nothing about the conservatorship that creates an explicit guarantee. Creditors to Fannie and Freddie today are at risk, and the taxpayer has no obligation to them. So let's just start as a pure legal matter. That's the law today. And so those who would say, well, rates will have to go up outside of conservatorship because the guarantee goes away. Well, that's wrong, because there's no guarantee today. But let's put that aside legally, because obviously there's the law and then there's people's perceptions about the law. I think it's best to conceptualize an implied guarantee as essentially a probability. And if we believe, let's just say for the sake of numbers, I'll start with my usual joke of, like, why do economists use decimal points? To show we've got a sense of humor. And so I don't want to give a too overly false sense of precision, but let's, for the sake of argument, say that the conservatorships and the PSPA create, let's say, a 75% chance that were the GSEs to become insolvent, GSE creditors would be assisted by the taxpayer. Let's just use that as a point of reference. Okay, so the way I read the concerns out there is that exit from conservatorship would lower that probability. Let's, for the sake of argument, say 45%. I mean, I think there is no chance at all that post-exit, the chance of a rescue goes to zero. And I think that's a fair, there's almost always going to be some sort of implied guarantee. And let's also emphasize as the bigger issue. I mean, does anybody think that General Motors would be allowed to go down without assistance from the federal government? Does anybody think American Airlines would go down without assistance from the federal government? Does anybody think Citibank would go down without assistance from the federal government? So it's important to keep in mind the objective here is not to fix everything with Fannie and Freddie. It's really just to get them on par with other large systemically important companies.
Too big to fail.
Exactly. I mean, again, I joked pretty regularly when I was FHFA director that my objective was to get Fannie Mae only as highly leveraged, mismanaged, and poorly regulated as Citibank. So it's what I was shooting for. Felt that that was a reasonable set of goals. But let's get back to the numerics and say, okay, the probability declines. So therefore, perhaps spreads would go up. I think that's a possibility. My money is maybe you're talking 10 basis points. But as importantly, I think there's a number of things the administration could and would do to make changes to offset that. And of course, it's worth reminding everybody that since I left, obviously rates went up because of inflation, but the spread also went up. So the spread between agency MBS and the 10-year Treasury has been 50 basis points higher on average since I left. And some of that is policy choices. And for instance, there was a Congressional Budget Office CBO study a couple of months ago that calculated that under the previous administration and the Biden era, 60% of GSE borrowers paid more so that 40% could pay less. And so, yes, the argument would be some borrowers would see little interest rate increase and maybe a decline, and some borrowers would see perhaps an increase. And I do think a part of the fundamental distinction here is that the Democrats tend to be extremely hostile to risk-based pricing. They basically think everybody should pay the same rate, kind of like FHA. And Republicans tend to believe that if you have spent your life behaving and saving and trying to build up good credit, that you should be rewarded for that. And that while, of course, bad things do happen to all of us, that most subprime borrowers got there through choices of their own, and they're not victims of the system, and that therefore you should be rewarded for having better credit. So I think this is actually the real dynamic in that after an exit, part of this cross-subsidization would likely go away in that you would see, again, little to no change in rates for essentially prime borrowers. And those borrowers who are a little more subprime would perhaps see an increase in their rates. Again, I think that that's fine. And in fact, I don't think it's just fine. I think it's important because rates are prices and prices are information. If you're going to a lender and they are quoting you a very high rate because you're subprime, that is a message to you, the borrower. Perhaps it's a message that you should spend 6 months getting your credit fixed up. So to me, again, I think it's a bad decision to blunt market signals. And that's what's been going on in the conservatorship. And so therefore, there are other factors. So for instance, one of the things that I think has become a real problem in the industry, if you go back and you look before 2008, it was on average about 260 days from last payment to foreclosure. Today, it is almost 1,200 days before somebody stops paying before they're foreclosed upon. All of that enters the spread. It increases servicing costs. It increases credit costs. So to me, why are rates going up? Are there things to offset that? And so I do think we need to get back to a world, and let me emphasize this, in post 2008 and the great financial crisis, I had two close relatives go through foreclosure. It's not some abstraction to me. I get it, and it's painful. And every foreclosure is a tragedy, but a bigger tragedy is to have a system where you don't allow any foreclosures because that will raise costs in the overall system. So you can kind of see I'm a little bit passionate about this because one of my big pet peeves, and let's remember Dodd-Frank and the regulations that came out of the great financial crisis have almost quadrupled the cost of originating a mortgage. And we've seen massive increases in spreads. So when I see, people from, the Obama Dodd-Frank team tell me they're worried about mortgage cost increase, I'm like, well, it's about time after what you guys did. And so let's figure out, how do we bring costs down in a rational way while having borrowers face the actual risk of their transaction. I think there's a lot we can do to bring down the cost of originating a mortgage. And I think there's a lot we can do to deal with this endless of cycling of people through loss mitigation without a resolution. And I think that can bring down the cost of a mortgage. So on net, I think we'll see mortgage costs come down if you implement this whole suite of things. I recognize people are focused on this one piece, but I lastly want to, maybe push back on the underlying assumption. Let's go back to the original analysis of probability of assistance from government declines, therefore rates modestly go up. Well, at the end of the day, what is that telling us? That's telling us that the GSEs fail, that creditors are more likely to take losses, but that also means the taxpayer is less likely to write a check. And one of my great frustrations in working in housing mortgage policy forever is we somehow pretend that homeowners aren't also taxpayers. And so this argument of, I'm going to take $10 out of your right pocket and put $9 in your left pocket, and you should thank me for it, I'm not terribly sympathetic to that. I mean, it's important to keep in mind, Congress created no guarantee for the GSEs. They're not going to. I see no world in which this Congress comes in and creates a guarantee. So how do we fix this world? And lastly, let me say, there is what the finance folks would say, a loose Modigliani-Miller effect here for Fannie and Freddie. And what that means is, if you're really concerned about mortgage spreads, then you should support high capital. Because at the end of the day, what will give mortgage and MBS investors more comfort is having more capital in front of them on the balance sheet of the GSEs. And that's exactly where we were going. And to me, I think it's very telling that some of the critics of exit are also people who've complained about having strong capital for Fannie and Freddie. Well, which is it? If you want to protect the MBS market, then you should want a lot of capital on the balance sheets of these companies.
This is
certainly
Fannie, sorry.
I think Fannie's up to 90 or 95 billion. Freddie's at 55-ish or so billion.
A lot of progress has been made since, as a reminder, when I started, they were leveraged 1,000 to 1. So today it's only 60 to 1. So certainly considerable amount of progress.
Absolutely.
This is the big picture presented by our friends and partners at Depth and Rich Swerbinski with Onward and Upward Consulting, joined by my co-host, Rob Krisman. Our guest this week, former FHFA Director, Mark Calabria. And Mark, past appearances, you've noted that the release of the GSEs from conservatorship does not have to go through Congress. I'm assuming that's the path that Trump and Pulte will take when they go down that road. But I wanted to dig a little deeper on that. Like expected resistance from the Democrats. How easy is it to get it through without Congress? Is there a path to take it through Congress because it's Republican that could be an alternative?
So, I mean, let's just start as a legal matter. The Fannie and Freddie conservatorship is based on the framework that the FDIC uses. So just like, when Silicon Valley Bank failed and was released, you didn't have a congressional vote. It's the same framework. Now, it will take, let me start with, there is zero chance of a 2025 exit. There's just too much mechanically that needs to be done. It's not a difficult process, but it is a labor and resource intensive process. And it does take time. This is why I would say, again, zero chance it happens this year, but I give it about a 65% chance it happens by 2027, 2028, because you can put a lot of pieces in place. And the importance of that, as well as it gives Congress an opportunity. And let me, be very clear here. I would love for Congress to come in and fix really parts of this. I just don't see it happen. And I mean, I think for the most part, there's not even really a consensus among Republicans what to do. So, forget getting Democrats on board. You don't have all the Republicans on board today on what to do. Huge disagreement over what a nature of a guarantee. And of course, in this budget environment, I don't think folks are going to rush to say, yeah, let's add $7-8 trillion to the national debt right now. These are going to be tough issues. And I think a lot of people will look at this and say, if somebody else can fix it for me. So for instance, after I got confirmed back in 2019, I did a lot of visits on the Hill, Republican, Democrat, House, Senate. And I will tell you, not a single member either side of the aisle told me to stop. Now, they were clear that if it went sideways, they were going to be more than happy to blame me. So this is why I kind of go back to the psychology issue of it for the director. If Pulte is a sort of guy who's willing to own it, you have to go into this job saying people are going to criticize me, people are going to, throw, rotten tomatoes at me. And if you're fine and you're comfortable and you can navigate that, you can get it done. If you're somebody who, you worry too much that people are taking shots at you, then you're not going to get it done. But again, Congress, quite frankly, if they think you can fix that and save them the trouble, they're happy to have that. I think it's also important to keep in mind you've got members already who have signaled, both French Hill, who's chair of House Financial Services, and Tim Scott, who's the chair of the Banking Committee in the Senate, have both signaled, Congress, the FHFA can do this on its own. I think that they will hold the line in terms of criticism. I'll also note, as an interesting kind of point of history, French Hill was actually at the Bush White House and worked on the 92 GSE Act. So this guy's been involved in these issues for a very long time. He was at the Bush White House, Bush 1. And I would go as far to say, I don't think you'd find a member of Congress who understands the GSEs better than French Hill, who is the chair. And so you're going to have certainly members who weigh in there. And if you kind of work with them, which you want to do, and you want to keep them informed, which is what we did, both sides of the aisle, it might surprise people, but I was on the phone pretty regularly with Maxine Waters and Elizabeth Warren, telling them what I was doing. And so some of this will really be, and this is where I think there's a bit of an open wrinkle, is how quickly does Pulte learn how to handle the Hill? Because the Hill can make a lot of problems for you, or they can be your friends and give you a lot of cover. And, to me, as I always kind of phrase it, yeah, there's a lot of people in Capitol Hill who I never would have voted for, but somebody did vote for them. And that gives them legitimacy, whether I would have voted for them or not. And as a agency head, you have to respect that and appreciate that and understand the role they play. It doesn't mean you need to wait on them to legislate, but it does mean that you keep them in the loop. You brief them. Again, I'd emphasize, I never took a major move as FHFA director that I didn't call Maxine Waters first and tell her we were going to do it. And again, you got to let people feel like you got to make people are part of the process. So that said, maybe, obviously I know MBA has got a lobbying platform and other people, HPC, others. Good luck. Everybody, I think Congress should fix elements of this. I'm just not terribly optimistic that will happen. But it is important to emphasize the process will take long enough to give Congress sufficient opportunity to act if it so chooses.
We had a flurry, I don't know, 2, 3, 4 weeks ago, Rich, and you probably remember better than I do. Somebody was Bill Ackman.
Bill Ackman, yeah,
was pounding the drum about buying Fannie Mae and Freddie Mac stock. Was that what he was doing?
No, he owns a ton of it. He came out with, his thoughts on recap and release strategy, if I'm correct, Mark, right?
He did. Let me also make a point on, a couple of things on the timing. So maybe so over the course of the conservatorship, FHFA has often used the conservatorship to do things that normally are done as a regulator. And the best example of this is, you gentlemen may remember that I finalized a new products rule when I was director. And previously to that, it really went about the case that the Fannie would come to the conservator and say, oh, we want to do this. And the conservator would say yes or no. And that was it. But Congress required a new products rule to be put in place. So we did a notice and comment rulemaking. And of course, the Freddie second mortgages went through that. And to me, part of the importance of that, of course, was stakeholders like the industry were able to comment and weigh in a way that was far more transparent than the conservatorship. But the importance here on timing is there's a whole host of issues that have been done under the conservatorship that need to be hardwired and translated into regulation. And the reality is to do this by regulation is going to take you 12 to 18 months because you got to take comment, you got to follow the Administrative Procedures Act. And so now the plus is I had the legal staff at FHFA go through everything we did in the conservatorship and, basically put the category, what's the legal authority? How would we do this by regulation? So the plus for Pulte is when he walks in the door, that list is there. He can immediately go to that list. So we should expect probably about 3 months after he's in, if confirmed, that you will see a number of regulations proposed. And of course, that allow the industry to offer comment, offer feedback. But this really needs to be done before the exit. And again, this is a 12 to 18-month process.
And then would that be like, just for the listeners and viewers, like signs to look for, I guess, like first steps from Pulte and FHFA? Is that kind of what you were alluding to there? The regulatory comment periods, that is something that could tell us that's the beginning of the process.
Absolutely. And one of the things, and I've said this to Bill, obviously it'll be his decision if he gets confirmed. I'll start by reminding everybody, I didn't get a heads up when the Collins case was, decided, the Supreme Court case that made me at will. I found out that morning, like everybody else, that's what the game was, that I had to the end of the day. And I think if we had had more time, I would have had Houlihan Lokey kind of put together a public roadmap. So Houlihan Lokey is the reorganization firm that FHFA has used. We spent a lot of money. They came up with a lot of roadmap, and unfortunately, none of that's public. So what I would urge FHFA to do is to have, and again, some of it is proprietary to the GSEs and can't be made public for that reason, but a lot of it can be made public. So I think it would be really helpful for the industry if you put out there, if FHFA puts out there, here's our roadmap, here's a summary of a lot of what we've done internally to help market participants kind of understand what some of the choices and trade-offs are. And again, I regret that we ran out of time and we're not able to put out more public. And I think it would be really helpful if Pulte early in his tenure, put that out just to help people understand, what some of the trade-offs are and some of the considerations that have already been extensively analyzed.
And you noted, Mark, on your last appearance, like when we go down this road, Fannie and Freddie have obviously lost a lot of talent, a lot of bench strength over the years. Their boards would probably have to be redone. If you could just walk us through like some of the things that would have to happen probably on the GSE level to help facilitate an exit.
Yeah, and let me also kind of add for the timing. When we were gonna really, look at a release in 2020, we were gonna have to do a public offering, and quite frankly, it would have been the largest public offerings in history. Now, fortunately, the GSEs between the two of them are probably kicking out about 25 billion a year that they are adding in net worth. And you do need to build about at least another 100 billion between them. And so one of the reasons that you're actually better off, in my opinion, having another 2 to 3 years is because you can build that without having to go to the capital markets and raise it. Of course, you do run the risk that, you get a housing market downturn, burn losses, and you may miss your window. We really, it was a short window in 2020. So, and you also want to make sure that you are retaining the right talent, as you've touched upon, Rich. I mean, there'll be a process almost certainly where FHFA evaluates the current executive teams and the current boards. And normally, if there's board members released and executive team released, you kind of take that as a sign of corporate stress. In this case, you should take it as a sign for there's a preparation here. And we did a fair amount of that, more over the course of my tenure than all at once. So for instance, I brought on a former SEC commissioner so that, at Freddie, we brought on former FDIC chair Sheila Bair at Fannie. And so bringing more kind of talent that has experience as large financial institutions, I think is incredibly important because you want to get to the point where you have the expertise on the boards. And we hired people with IT expertise. To the extent of, obviously, the mortgage industry and Fannie and Freddie are hugely IT intensive. And you want to make sure concerns. Could you imagine what happened with if all the IT, at Fannie and Freddie or one of them just went down? I mean, I actually spent a fair amount of time obsessing about, Amazon Web Services and making sure the companies could fail over. I mean, there's a lot of crucial infrastructure questions you have. And that's why, for instance, we recruited IT talent to the boards, as well as obviously the exec teams. So given that the last previous 4 years has kind of been paused on any sort of thought of getting out, you're absolutely going to go through a minimum of a 6-month period where there is an evaluation of saying, are these the right executive teams? Are these the right board members? My gut is that most of the boards from both companies will stay. You'll see a few people replaced. I wouldn't prejudge, what's going to happen to CEOs. Having led CEO searches, it's tough because, as you say, you've got a salary cap from Congress on the CEO. You've got a fair amount of uncertainty when this happens. So, I mean, I did the process for DeVito at Freddie, and that was tough getting there. You really went through candidates, and so needless to say, there's a lot of work, under the corporate governance label that needs to be done. And this is why I say I think there's a very good chance they get out, but you got to do a lot of work. And, maybe all this has been done, but from the outside, it looks like very little has been done in the last few years that you need to do on this front. So that said, if I could wave a magic wand and they could get out day one, that would be great. But there really is just a lot of work that needs to be done. But the takeaway really is it can be done. It's all doable. You just got to be willing to hire the resources and throw the resources and the time at it.
You've spoken in the past, Mark, about your good working relationship with your Treasury Secretary Mnuchin, Scott Bessent, the Treasury Secretary now. Do you know him at all? How do you the working relationship with Pulte? How do you see all that playing out?
I think that's critical. Me and Mnuchin, partly because I was at the White House for 2 years and, worked on taxes and trade issues and had gotten to know Mnuchin for 2 years before I became an FHFA director. And you also had this combination as a reminder. I mean, Mnuchin not only had, his One West mortgage experience, the guy was an MBS trader early in his career. So you really brought, I'd go as far to say, I don't know that we've ever had or will ever have a Treasury Secretary who understands the mortgage market and the mortgage capital markets better than Mnuchin. I mean, so I don't think lightning's going to strike twice in that regard. And again, I brought obviously my experience from Capitol Hill and Washington, so it really was a great compliment, and we got along really well and mostly saw eye to eye on things. So I do think that, what kind of relationship, as far as I know, there's no real history between Pulte and Bessent. Again, there was no history between me and Mnuchin before 2017, so you're gonna have to build that history. It is important that they work together. I do want to emphasize, however, that while Treasury has an important role, this is fundamentally 90% FHFA's job to do. So it really is going to fall on, does Pulte have, the character, the push through to do this? And you also have to remember, and I know this is painful for the three of us to recognize because the three of us are fascinated about the mortgage market. Treasury any one day of the week is dealing with 10 other issues in its mind that's more important than the mortgage market. I think I was saying to Rich beforehand, I remember during the pandemic walking out of Mnuchin's office and Doug Parker, American Airlines CEO, was passing me on his way in. And so you could imagine Mnuchin and I talking about stabilizing the mortgage market, and then suddenly Mnuchin spends the next hour talking about stabilizing the airline industry. It's actually stunning the number of issues that the Treasury Secretary gets pulled into on a daily basis: trade, sanctions, national security, budget, tax. And so, again, yeah, I wish that mortgage finance was higher up on the list of priorities, but we would be naive if we told ourselves that Treasury is going to make it a top 5 priority. They just have so much else going on, and this is why it fundamentally falls to the FHFA director to make this happen.
Yeah.
Hey, Rich, I know we've got 90 seconds. Do you want to talk about any of the questions that have come up in the?
Yeah, we've had a bunch of questions, a few about like the stock price in the Q&A. What happens to the stock price if they're private, up over 300% since the election. Before conservatorship, Fannie Freddie distributed the dividend to the common stockholders by 17% of their profit. When do you think they would resume the dividend, and how much would it be? Those were a couple in the Q&A. And then also another question about any chance of the GSEs being uplisted to the New York Stock Exchange before exiting conservatorship.
Let me just say, in the off chance that my friends at the Securities and Exchange Commission are listening, I'm not going to comment on anything that sounds like investment advice.
Yeah.
So,
Okay.
all of these things are going to be factored. I would say, and not to be a downer, but to be realistic, the administration is going to approach this in such a way that whatever happens to the shareholders is incidental. No one's looking to screw the shareholders, but no one's looking to reward them either. And what happens to them is just going to be a function of the process.
Mm-hmm. One more question came in from Guy Schwartz. We all know that housing needs a supply side kick in the ass. What can
That
the
it does.
administration do to spur additional supply?
So there are a number of things that I think can be done. I'm not convinced how much of this can be done, Fannie and Freddie. I would say first and foremost, to me, the biggest area of concern I have is acquisition development, construction lending. As you know, we've lost about 40% of community banks since Dodd-Frank was passed. And as much as I spend a lot of time complaining to the big mega banks, why won't you do more ADC? But at the end of the day, we really need to see kind of a rejuvenation in community banking so we can get more ADC blending back. And that's why one of the reasons why the bigger builders who have mortgage arms have been able to take so much market share. So how do you get ADC blending back in a big way is a top line issue to me. I actually am pretty excited about some of the proposals, and I've talked to the teams at Interior about some conversion of public lands out west to housing. We do this already. Interesting enough that Rob is in Las Vegas. We do this already for Las Vegas. There's a long-standing, decades-long process where federal land in Clark County can be converted to housing. Unfortunately, it's limited to Nevada. You'd be surprised if you drove around Denver how much federal state land is within Denver Metro. There's a lot of federal land within cities in California, for instance. So nobody's suggesting condos in Death Valley. What we are suggesting, what I am suggesting is there's a tremendous amount of federal land out west within metro areas where we could get 2 to 3 million new units built on. And I think that should be a primary focus. And my understanding is I believe he was actually just confirmed this week, the Interior Secretary is interested in the topic. And this really takes a marriage with HUD, the White House, and Interior to be able to work on this to make progress. But I think there really is a focus and understanding of it's the supply side of the market you need to focus on and not focus on, more demand subsidies without trying to get some changes on the supply side.
Great stuff, Mark. As always, top-notch insight. I really appreciate you coming on the show, sharing this with our viewers and listeners. If you're watching or on YouTube or listening on the podcast, join the live show. We had almost 2:30 live at one point today. So nice little audience. And you can go to chrismancommentary.com to get signed up for the live show. Of course, this goes immediately to podcast and YouTube as soon as the show ends. And I want to thank all of our attendees for spending part of their Thursday afternoon with us. We're here every Thursday live from 3 to 3:45 p.m. Eastern here on The Big Picture. So there we go.
I'd like to remind folks that Mark's opinions are Mark's opinions.
Exactly.
He's not speaking for anybody. And also thank Depth.
Our friends and partners at Depth, outstanding public relations and marketing firm for the mortgage fintech industry for 2 decades now. Great company. You can find them at depthpr.com. So good stuff. Thanks again, Mark. Thanks to our attendees. And hopefully we'll see you next Thursday. And have a great rest of the week and weekend, everyone. And we'll see you next week. Take care.
You're well, everybody.
Guys.